Hello, here we are again. Last lecture, what we did was we talked about, we're in the chapter, let me back up a little bit. We're in the chapter on merchandisers, on retailers, right? Like Best Buy, like Walmart, those sort of things. These companies that they don't manufacture goods, they purchase goods from manufacturers and then they sell them to customers, right? One of the things that we talked about was that merchandisers or retailers, they wear two hats. They do a lot of purchasing for manufacturers and they do a lot of selling to customers, right? Now, last lecture we talked about the purchase cycle. The retailer purchasing for manufacturers, okay? And we have a homework problem over that, right? Once we go over that homework problem, we're going to switch gears and we're going to start talking about the sales cycle, selling to customers, okay? So let's do, I think I just assigned exercise 5.1, is that right? Okay. So let's go over our homework, exercise 5.1. Hope you folks at home are doing your homework. These media classes or online classes, I think, are very effective as long as you're disciplined and doing your homework. Of course, I'm not going to be there to know if you're doing it or not, or if you're even watching the lectures. So, okay, let's take a look at exercise 5.1. Prepare journal entries to record the following transactions for a retail store. Assume a perpetual inventory system. Okay? And we'll talk about what that means when it says assume a perpetual inventory system. We'll talk about that a little later. April the 2nd. Purchase merchandise from Blue Company under the following terms. $3,600 price, invoice dated April 2, credit terms of $215, net $60, and free on board shipping point. Okay, we talked about shipping last time, didn't we? Free on board shipping point. Who's going to eventually pay for this? The buyer or the seller? Free on board shipping point. The buyer. That means it only is free up to the point where they start shipping it. So the buyer is going to end up paying for it. Okay? All right, the first journal entry on April the 2nd is as follows. Let me straighten that up a little bit for you. Let me see if I can enlarge that a little bit. Okay, that's about as good as I'll get. Okay, we debit merchandise inventory and we credit accounts payable. Now what they did is they have accounts payable -blue. That's not really a totally new account like on the balance sheet or something. They're just keeping track of which accounts payable company it is. Sometimes people put it in parentheses. Okay, it's kind of easier when you're doing this sort of thing and you're going to be dealing with two vendors. Okay, so we debit merchandise inventory and we credit accounts payable blue. All right. All right, let's say we paid April 3rd, we paid $200 for shipping charges on the April 2 purchase. Okay? Now, what do we debit here? What do we debit? Merchandise inventory. Now, you may be tempted to debit transportation expense or delivery expense. But as we talked about, I know we kind of hurried through it at the end of last lecture, with transportation charges, we debit merchandise inventory. Kara?
Why wouldn't you debit the accounts payable?
Okay, let's go back to the Elmo and I'll show you. This is an accounts payable to Blue. Okay? Here we're paying shipping charges on the purchased merchandise. It's not to Blue. Okay? It's probably to, Federal Express or UPS or something like that. Okay? And if it was to Blue, they would send a separate invoice or something like that. Okay? So that's a great question. That's a great question. And if ever in doubt, I'll try to be real clear on the test as far as, is this a separate company? But usually, in this sort of situation, it is a separate company, a separate delivery company. And if it's not, in the first transaction on April 2nd, it would say $3,600 plus such and such for delivery expense, or including, or whatever. Okay?
If it's a separate company doing it, why wouldn't you put that separate company you're debiting, like, you know, like FedEx, and then cash, because you're paying.
Okay. You mean as far as accounts payable?
No, like on the 3rd.
Yeah.
If you're paying a separate, like I put, you know, because I didn't really understand. I put shipping cost.
Okay.
And then cash. I credited cash.
Okay. Again, that why aren't we debiting shipping costs or something like that? Let me give you an example that I think kind of clarifies it. Okay. Let's say that the retailer we are dealing with here is a piano retailer. You ever seen those stores that sell pianos? Okay, they have one over in Rosanna Square, I think it is. They sell pianos, right? Sometimes I wonder, do they go whole days without selling a piano? I got to imagine it gets pretty lonely in there. But anyways, let's say we have a company that sells pianos, okay? And let's say that we have been buying from vendor A, okay? And the vendor A, the cost of the piano is, I have no idea what a piano costs, so I'm just going to make up some numbers, okay? Let's say the cost to us, now this is not our selling price, okay? This is not our selling price. This is the cost of the piano, okay? Matter of fact, let me even clarify that more by saying the selling price to the customer is going to be $3,500. Okay? Okay, so you with me? So the selling price to the customer of this piano at our piano store is going to be $3,500. Now, vendor A is one place we can buy these pianos, and the cost of a piano at vendor A is $1,500. You with me? Okay? We can buy them from vendor A for $1,500. And vendor A is local. Okay? So, and as a matter of fact, even that small local delivery is free. Okay? You with me? Okay, let's say we're considering purchasing from a different vendor. Vendor B. Okay? And the reason we're considering vendor B is because the cost is only $1,400 for those pianos that we're going to sell to the customer for $3,500. However, vendor B is located in St. Louis. Okay? So there's a delivery charge there, isn't there? And let's say the delivery charge is $200. Okay? Well, do you see where the proper way to account for this is that the cost of the good that we're eventually going to sell to the customer is really $1,600. Okay? Because if you just kept track of that $200 separately and just we're looking at $1,400 versus $1,500, you might ascertain that the vendor B is going to be a better situation and give you a higher gross profit. Remember, gross profit is your sales price minus your cost of goods sold, right? But we need to keep track of that cost in our inventory account at $1,600. Does that make sense? Not the $1,500, because the cost of the good that will eventually be sold is truly $1,600. Does that help at all, Marlon? Okay. Otherwise, you might make some erroneous decisions as far as the prices that you charge your customers, the sales prices that you charge your customers. So one common thing that you'll hear in accounting is that whatever costs are needed to acquire a product are captured in the asset itself. Okay? So let me give you an example. We're in this television studio, right? And we have these big lights that are above us. You at home can't see them. But they had to purchase these big lights, right? Let's say they purchased these big lights, and this is going to be a fixed asset on the books of JCCC. Are you following me? So let's say they paid $3,000 for these lights. But then they had to pay $400 to have them delivered because they're very, fragile, so you have to be very careful in delivering them. And then they had to pay $200 to have them installed. Okay? So they paid a $3,000 cost, they paid $400 for delivery, they paid $200 to have them installed. So they had a total of $3,600 to get these lights and to get them in working order for the college, right? Those lights would go on the book at $3,600. You with me? And that's how much we would depreciate. Whatever costs are reasonable and necessary to obtain the inventory, or in this case, the fixed asset, becomes part of the asset. Make sense? Good questions. Okay, so going back to exercise 5.1, the answer to April 3rd would be a debit to not shipping expense, but to merchandise inventory. Okay? And a credit to cash. All right? Okay, April the 4th, we returned to Blue Company unacceptable merchandise that had an invoice price of $600. So we haven't paid him yet, so they just reduce our accounts payable to them. And of course, we decrease our inventory account, don't we? Because we no longer have that. Now, how much at this point do we owe Blue? Remember, this is to a separate company, the shipping. We owe them $3,000. The $3,600 minus the $600. We owe them $3,000. Do we pay within the discount period on the next transaction on April 17th? Yeah, we do, because remember, this is $215, isn't it? This isn't $210, it's $215. So we don't have to give them the full $3,000. We only have to give them 98% of $3,000, which is $2,940. The entire accounts payable is debited. It goes away. We don't owe them anything else. And that difference goes to reduce merchandise inventory by $60, because we want the merchandise inventory to be reflected on the books at the actual cost that we ended up paying. Does that make sense?
Those credits, it doesn't matter which way you put it around, does it?
You mean as far as what order you put?
Yeah, I'd put cash first.
That's all right. If they're both credited, you can put cash before merchandise inventory. And that's how it is always for journal entries. You can have these in different orders as long as you're consistent on the accounts being debited and the accounts being credited. Okay? I can remember once, I know you love to hear stories about my past, but I was retained as a consultant for an accounting, or for a company. And they had an old accounting system that they had been keeping track of their records on. And they had a new accounting system that they were starting to use. Well, here was the problem. They didn't know how to do everything on the new accounting system. So what they did, and this is the worst decision they could make, they used their new accounting system for the transactions that they understood how to make, and they used their old one for the ones they hadn't figured out yet. So they basically had two separate, non-integrated accounting systems where they're keeping track of stuff. Are you with me? So what my job is to integrate all that into one. And unfortunately, they had been doing this for a long time. So I say all this because it's one of the proudest things I've ever done as an accountant. It took 3 weeks to figure out the journal entry. And I won't go into all the complexities because you might think that's not that hard of a deal. It was very hard because you wanted to maintain the integrity of being able to reconcile your cash and all that and stuff. But it took me 3 weeks as far as digging around to make this one journal entry. And that one journal entry was about 120 lines of debits and credits. And but we finally booked that journal entry and held our breath, and it worked. It worked. But that was 120 lines of journal entry. Can you imagine that? Yeah. And we'll be working on that sort of a journal entry in chapter 6, actually. I'm just kidding. We're not going to. Okay? All right. Going back to this. Is there any questions? This is kind of in exercise 5.1, there's kind of two situations going on, right? The first one was with Blue Company. And I think we're all settled with Blue now, aren't we? But on April 18th, we purchased merchandise from Fox Company or Corporation under the following terms. $7,500, invoice dated April 18th, credit terms 210, net 30, FOB destination. Now, FOB destination means who's going to pay? Who's going to pay transportation, I should say? The seller. So we're not going to have any separate shipping bill here because we're the purchaser. The seller is going to pay. So the journal entry we make on the 18th of April is a debit to merchandise inventory and a credit to accounts payable. And they just kind of say this is to Fox, just to kind of separate these. For $7,500. You with me? Now, what happens on April the 21st? After negotiations, we received from Fox a $2,100 allowance on the April 18th purchase. Now, do you remember us talking about purchase returns and purchase allowances? Purchase returns are when I physically return the good to the seller and they decrease my accounts payable. Like if you take a sweater back to JCPenney's. An allowance is there was something wrong with it, and so they're saying, well, if you want to keep it, you can. We'll just knock off some of the price of what you owe us. So we're essentially buying it cheaper. An allowance, we do not physically return the good. Okay? But they look very similar, as you'll see. Because in this situation, for the allowance on April 21st of $2,100, we reduce our payable to Fox and we reduce our inventory both by $2,100. Now here is, right here where I'm pointing is an allowance. And right up here was where we returned unacceptable merchandise. They look very similar, don't they? In that an accounts payable is debited or decreased, and the merchandise inventory is credited, decreased, right? So they look very much the same, but in the return, we return the good. In the allowance, we keep the good. Cool? Now, at this point, how much do we owe Fox? $5,400, right? The $7,500 minus the $2,100. Do we pay within the discount period? Yes, we do. So we do not have to give them $5,400 worth of cash, do we? We only give them $5,292. Cool? All right. Any questions on that one? If not,
So you do the 2% to the money you had knocked off, the 2,100, the 7,500 minus the 2,100.
yes. It's a good point. Good point, Matt. You have to figure out how much do we owe them at this point. You take the 2% of 5,400, which is 7,500 minus 2,100. Okay? Don't take the 2% times the 7,500, because at this point we don't owe them 7,500. We got an allowance. Make sense? Good question. All right, anything else on there? Okey-doke. Now what we're going to do, if I had a separate hat, I would take this hat off and put this hat on. One of my students once suggested I should actually get hats. I thought that was kind of a goofy idea. So I'm not going to do that. But one of the things that's very, very important in this chapter is that you are shifted into the right gear. We've been talking about purchasing from the manufacturer. Take that hat off, put a new hat on. We are now going to talk about selling to the customer. Not the manufacturer selling to, no, the retailer or merchandiser selling to the customer. In this whole chapter, we're from the perspective of the merchandiser or the retailer. But now we're not going to talk about purchasing anymore. I mean, you have to purchase to stock your store, right? But how do you make money? Put your seller hat on, now you sell to the customer, correct? That's what we're going to talk about now, is the sales cycle, okay? So, let me get down to that slide. Should have been queued up before class, sorry about that. Okay, we're going to account for merchandise sales now. Now, I want to look at the top half of an income statement for a merchandiser. And what you're going to see is we have our sales here, right? And we know that sales are like revenues, right? We just call them sales for a merchandiser. But now we have these two new accounts called sales discounts and sales returns and allowances. Now, what type of accounts are these? Well, we can see that these are deducted from sales to arrive at something called net sales. What these new accounts are, sales discounts and sales returns and allowances, these are contra revenue accounts. Where'd my pointer go? Where's my pointer? Oh, there we are. Okay. These are contra revenue accounts. I ended up messing it up, didn't I? But these are contra revenue accounts. Now, we've talked about contra asset accounts, right? What was the contra asset account we discussed? Accumulated depreciation. And what did we decide that contra means? Opposite. So a revenue account is a credit balance account. Agreed? So what balance do you think a contra revenue is? A debit balance. Now, remember those flashcards you hopefully made? Hopefully, as you're progressing through this class, when we introduce new accounts, you're going to make a new flashcard or two. You should make a new flashcard for sales discounts. You should make a new flashcard for sales returns and allowances. And these are contra revenue accounts. They go on the income statement, as we can see here. And they have normal debit balances. You with me? But we keep track of these sales discounts and sales returns and allowances and arrive at net sales. Then we know that sales minus cost of goods sold equals gross profit. We knew that from the quiz we took, right? But we have two new accounts here, sales discounts and sales returns and allowances, okay? We'll talk about those today. First of all, let's look at the basic journal entries for when we sell merchandise as a retailer. On March the 18th, Diamond Store sold $25,000 of merchandise on account. The merchandise was carried in inventory at a cost of $18,000. Okay. Now, one thing you need to kind of be a little bit cognizant of is I've been urging you to think of retailers like Walmart and Best Buy and JCPenney and those sort of things, right? Well, when you buy stuff as customers from there, you never buy on account, do you? Don't you always just pay cash? Okay. Well, those companies do, retailers do sell on account a lot as well. Now, it's easy if you sell on cash. Okay? You just don't debit accounts receivable. You just debit cash as the seller. But we're going to be learning about when you sell on credit as a merchandiser. Okay? So looking back at this example, here's what you need to do in this situation. If on March 18th you sold $25,000 of merchandise on account and it was carried at a cost of $18,000, you make two journal entries. You make two journal entries. Now this is kind of new because you're used to one transaction equals one journal entry, right? Well, here we have one transaction equals two journal entries, and I don't want you to combine those into one journal entry. I want you to keep those as two separate journal entries. And that's because we are using what is called the perpetual inventory method. The perpetual inventory method necessitates this second entry. Because you know what perpetual means? Perpetual means always, going on and on and on. In a perpetual inventory system, we are always adjusting our inventory when we make sales, and we do it right when we make the sale. Okay? So when we sell these goods, We debit accounts receivable and we credit sales for $25,000. And then we debit cost of goods sold and credit merchandise inventory for $18,000. Are you with me? Now there's also what is called a periodic inventory system. A periodic inventory system, that's not what we're studying now, but in a periodic inventory system we would only make the journal entry on the top. Periodic would mean that we only periodically update our inventory, like each month. Now, when I was a young boy in college, full of hopes and dreams, we studied the periodic inventory system, and then we studied the perpetual, and we spent about equal time on those two methods. Now, you folks, all we're going to really talk about is the perpetual inventory system, where inventory is constantly, perpetually updated. Why the change between the 1986 when I took this class versus 2011 when you're taking this class? Was I just smarter back then than you guys are, and so we can only teach you one method? Perhaps. No, I'm just kidding. Why are we only teaching the perpetual method now? Or why do we focus on it?
Because it's constant. Like you can do it in the computer.
Yeah. Okay, there's the word. Technology. Okay? Technology. It's all computers these days, right? When you go buy a basket full of goods at Price Chopper, and they're checking you out, they're scanning the barcodes, right? And you buy a box of Cocoa Puffs, and you buy some butter, and you buy some ketchup. They're scanning those things, right? Well, there's two things happening when they scan those Cocoa Puffs across the little lasers. It's saying how much you need to pay for those Cocoa Puffs, but it is also adjusting their inventory, Cocoa Puffs. It's decreasing it by a box, right? And it's decreasing butter by a tub, and it's decreasing ketchup by a bottle. That's all happening in the technology, right? And actually, it's not even that expensive of technology as you might think, these barcodes. You with me? Now, go back to a grocery store. Have you ever been to a grocery store where they didn't do the scanners? You guys are probably too young. But when I was a kid, they would stand at a cash register and it was like, you ever seen that? Okay. Watch an old Andrew Griffith show or Brady Bunch show or something like that, and you'll see them doing that. Well, can you imagine how difficult it would be to keep track of your inventory of Cocoa Puffs and butter tubs and ketchup without technology? It's like, we sold some Cocoa Puffs, a box. We sold a bottle of... No, you couldn't do it. You could not perpetually keep track of it. And that's why we learned those two methods in 1986. But now everybody, you can go probably to the smallest town in Kansas, and they probably have barcodes and scanners, don't they? And it's all technology. It's all set up so that once their Cocoa Puffs level gets down to it, automatically probably shoots an order to the manufacturer of Cocoa Puffs that we need more Cocoa Puffs. You see what I'm saying? It's all computerized these days. So we're not going to focus on the periodic inventory system. Okay? We're going to focus on the perpetual inventory system because people want to know how much inventory they have, don't they? They don't want to just know, at the end of the month we'll figure it out. No, we don't live in those times anymore, do we? We want to know now. So we perpetually keep track of it, and technology allows us to do so. So back to this journal entry. We debit AR for $25,000. We credit sales for $25,000. And now we're going to deal with on the lower journal entry with the cost of this. We debit cost of goods sold. What is cost of goods sold? For your practical purposes, it's a debit balance account, and you can kind of think of it as an expense. You might want to add a flashcard for that as well. Cost of goods sold is a debit balance account. It's on the income statement. Okay? You can think of it as an expense. And we credit or decrease our merchandise inventory because we do not have that inventory anymore, do we? The customer's taking it out to their car, correct? Now, In most cases, what's going to be higher, the sales price of an item or the merchandiser's cost of the item? What's going to be higher? The sales price. You're not going to stay in business very long if you don't charge the customer more money than what you paid for it as a retailer, correct? Now let me tell you where students mess this thing up. Okay? Well, they know, I mean, the journal entry is accounts receivable, sales, cost of goods sold, merchandise, inventory, right? And then, let's see, what were the numbers? 25 and 18? Was it 25 and 18? Okay, here's the entry. And it's like, they know that there's these 4 accounts. And they know that there's the big numbers on top and the small numbers on the bottom. But they get these all mixed up. They debit AR and credit merchandise inventory, or they debit cost of goods sold for 25. You know what I'm saying? They know that there's these 4 accounts. They know that there's these 2 sets of numbers, but they cannot figure out what goes where. You have to know which ones go where, right? This is in regards to the sale of the item. The sales price and how much the customer is going to pay us for what the sales price was, right? Here is us dealing with the cost of it. The cost of the goods sold. Our cost as the retailer. And then we decrease our merchandise inventory, and everything in our merchandise inventory is kept track of at cost. Okay? So you got to know which number goes where and which account goes where, or you'll get it all wrong. Yeah?
Can you still put that acronym in effect, that REAL thing?
No.
No.
No. The REAL,
Yeah.
that was good for AJEs. Doesn't have any application here. Okay? This is just one of those things you got to kind of know. Okay, but this is really an easy thing. This is one of many examples in this class of when you watch me do this, you're going to go, I got this, baby. Bring it on. I can take the test now. I can see what he's doing. Easy schmeezy. And then when I give you the test or the quiz and you have a blank piece of paper looking at you, you're going, I know that there were those 4 accounts. I have, you see what I'm saying? I don't know where they go. You learn this class not by watching me. You learn it by doing it and starting with a blank piece of paper. Now let's do something real quick. Okay? Let's, don't look at your notes. Just get a blank piece of paper out. Cover up your PowerPoints if you have them. And take a look at the screen. And I want you to make the 2 journal entries for the situation in purple. Pay no attention to the sales discount title for now. Just focus on this item in purple. And I'll give you about a minute to make those 2 journal entries on a piece of scratch paper for the June 8th purple situation. Okay, go ahead and do that. We'll be back in about a minute. Okay, what did that look like? Well, we debit accounts receivable and credit sales for the 6,000, the larger amounts, and we debit cost of goods sold, and you can abbreviate that CGS if you'd like, by the way, and we credit merchandise inventory for the cost of the item, which is $3,500, usually going to be the lower numbers. Make sense? Kara?
Do you ever have to make an account saying, like, how much you profited?
No. That's very good. That's a good question. We will eventually figure that out on our income statement. Going to the Elmo. We keep track of our sales. We keep track of our cost of goods sold, and we will compute gross profit. Okay? We compute this number. We did this and we did this, we'll compute that. it's kind of like this. Do you ever debit or credit an account called net income? No, we don't, do we? We keep track of our revenues, we keep track of our expenses with our service companies, and we computed net income. Same way with gross profit. Great question. Because it is important. Okay? All right, now we're going to deal with discounts and returns when we sell to our customers. Okay? So this is our situation to begin with, what you just worked with. Now on June 17th, first we got to do this. Remember how on the purchasing side, there was these incentives to pay early, for us to pay early? Well, we have those same incentives for our customers when we sell on credit for them to pay early. The terms of this sale going back were $210 net 30. Now they owe us $6,000 at this point, don't they? But if they pay within 10 days, they don't have to give us $6,000. They only have to give us 98% of $6,000, which is $5,880. You with me? Now, we decrease the entire accounts receivable because they don't owe us anymore. Even though they only gave us $5,880, they don't owe us anymore. They took advantage of the discount. What do we debit for that 2%? Well, remember we credited merchandise inventory on the purchase side? Here we're going to debit that contra revenue account called sales discounts. Are you with me? We're going to debit that account called sales discounts for $120. You with me? That's a contra revenue account. It will be deducted from sales, and it will allow us to compute net sales. Because we want to keep track of how much sales discounts we have. Okay? And read about this in your book, too. Paid a lot of money for those things. You might as well use them. Okay? Let's go on and look at some other situations here. On June 12th, we sold merchandise costing $4,000 for $7,500 on account. The credit terms were $210 net 30. Okay, the journal entries we make, we debit AR and credit sales for $7,500. We debit cost of goods sold and credit merchandise inventory for $4,000. So they owe us $7,500 at this point. But what happens? On June 14th, they returned some goods to us. Now those goods had a sales price of $800 and they were at a cost of $470. All right? How do we account for this? Well, we have to make two journal entries, and they're almost, let me go back, they're almost flip-flops of these entries as far as the accounts debited and credited. Okay? We credit accounts receivable, we debit merchandise inventory, we credit cost of goods sold, but we do not debit sales. We debit sales, returns, and allowances. This puts the item back in our inventory, this lower entry, and this reduces their receivable. And it's going to end up affecting net sales, so that net sales is lower than our gross sales, right? Because we don't want to debit sales because we want to keep track of sales, returns, and allowances separately. Okay? So how much does this customer owe us at this point? They owed us $7,500. They returned $800, so they owe us $6,700, right? So when they pay us, if they pay within the discount period, they figure out their discount based on the amount due at that time. Not on the original amount, because there was a return there. But they only have to give us 98% of $6,700, which in this case is $6,566. Does that make sense? Cool? All right, now I want to do something here right now. I want to do Quick Study 5.4. I think we'll have time for you to do it and for us to go over the answer. But we're going to roll the music for you folks at home. Do it as well. But let's turn to page 209 and let's do Quick Study 5.4. Okay? We'll roll the music. Okay, let's go over that. If you're not done at home, just pause it and push play when you are done. Okay, I won't read the problem since you just read it, and since we're running out of time here. But on April 1st, we made a sale of $2,000, and the cost was $1,400. Is that correct? So we had 2 journal entries to make on that April 1st. Is that correct? Is that what you all got? You didn't get your counts all mixed up, did you? Okay, you did? That's all right. I'd rather you do it now than on the test. Now, what happened on April the 4th? The customer returned merchandise and received credit for $500. The cost was $350. Okay? So we have 2 journal entries to make then. We have to decrease our receivable by $500. We do not debit sales. We debit sales, returns, and allowances. Okay? And then we put the item back in inventory, so we debit or increase merchandise inventory, and we credit or reduce cost of goods sold, because in the end, those goods were not sold, were they? For the $350. So there's 2 entries there. Now at this point, how much does our customer owe us? How much do they owe us? $1,500, right? Do they pay within the discount period? So they don't have to give us $1,500, do they? They only have to give us $1,470, right? They only have to give us $1,470, which was 98% of the $1,500. Okay? Does that make sense? Any questions on that? Okay, let me give you your homework. I'm going to warn you. You only had one problem to do for today, right? This is one of my longer homework assignments, so just prepare yourself, okay? I do this because I love you, okay? So what I want you to do for homework next time, the gasps. Remember, nothing is optional. You don't have to learn any of this. There's fast food jobs that are plentiful right now, okay? If this is too hard, okay? But I want you to read pages 190 through 197 and do the following. Now let me tell you, on that exercise 5.2, you only need to do requirements number 1 and number 2. And one thing that I think is helpful on 5.2 is to put your paper like this and solve it like that, where you put the buyer on one side and the seller on the other side. Because you're going to be analyzing transactions, the same transaction from the buyer's viewpoint and then the seller's viewpoint. And I think it's kind of helpful to do them side by side. So if you want to do that on 5.2, on requirement number 1 is the buyer, requirement number 2 is the seller, then go ahead and do that, okay? But that's your assignment. I know it's a little longer, so allow a little bit more time, but please do not blow this off. The way you learn this stuff is by doing it, not by watching Krug do it, okay? All right, folks, good class period. We'll see you.